In this video, we're going to be looking at Ark Invest brand new Tesla price targets for 2027. And spoiler alert, $2,000 per share in the base case, $1,400 per share in the bear case, and $2,500 per share in the bull case. I'll also be contrasting and comparing some of Ark's assumptions with my own. For those who don't know, which is about 3 of you, I do have a Tesla valuation model available exclusively to my Patreon supporters at the investor level and above, and that valuation model and all of the assumptions are what produces my Tesla fair value, aka formerly known as price targets. And my estimates for Tesla fair value over the next 10 years in the bear case, the base case, the bull case, and the hyper bull case are available to all Patreon members at all levels. If you're not a member, you can join with the card in the corner or the link in the pinned comment. And FYI, my most recent update to the valuation model and its outputs occurred less than 24 hours before Ark posted their updates as well. It'll be interesting to see if we're on the same page, or if we're not, how far apart our respective assumptions actually are. Oh, and heads up, if you'd like early access to my daily YouTube videos, I'm now posting early access to these videos, the one you're watching right now, to my Twitter subscribers. One of the many perks, I'm also posting loads of exclusive content, including a Q&A that went live moments ago. But if you'd like to watch these videos as soon as they're available, the only way you can do that is by subscribing over on Twitter at StephenMarkRyan. And again, thank you to everybody who's already subscribed. Ark's expected value for Tesla in 2027, $2,000 per share, published on 4/20, because why not? Ark's updated open source Tesla model yields an expected value per share of $2,000 in 2027. For context, as I record this, Tesla closed today at $165 per share. In other words, if Ark's expected valuation comes to pass, we'll see more than a 10x from where Tesla stock is today in 2023. The bull and the bear cases, tuned to the 75th and 25th percentile, in other words, 1 in 4 probability each, are approximately $2,500 and $1,400 per share, as shown below. Now, before we get any further, just FYI, for those who missed it, I posted updates to my own Tesla valuation model, which produces my own fair value for Tesla. In my base case in 2027, I'm just a little bit below where Ark's at. My own bear and my own bull cases, however, are much lower and much higher respectively. So we're looking at Ark's expected value for Tesla, $2,000 per share. This is essentially what you would call the base case. Ark's bear case, with a 25% probability, is $1,400 per share in 2027. And their bull case with a 25% probability is $2,500 per share. While my bull case has a 25% probability, just like Ark, my base case has a 69% probability. I actually have a much more extreme bear case at just a 3% probability. For me, I'd much rather be modeling out what is the absolute worst case, like 1 in 35 type probability scenario on the downside, rather than what's the 1 in 4 probability downside. I also have a hyper bull case, which is a 3% probability as well. That's just me thinking, okay, this ain't gonna happen. But let's just imagine literally everything could possibly go right, does go right, and everything goes even more right than I thought was possible. What does it look like? The same is true of the bear case, 3% downside. What's the absolute worst case scenario? And then what's even worse than that? Let's just have a look. I don't expect either of those to play out, hence the 3% probability, but I like to model them out. So just a key caveat here, my bear case, which is 3% probability, is significantly below Ark's bear case. My bull case, however, with the same probability is actually above. And my base case, not too far off Ark's expected base case either, but a little bit below. And of course, if you guys want to see the full valuation model and or the outputs, the fair value, aka formerly known as price targets, head over to Patreon. That's the only place you'll find them. You can join with the card in the corner or the link in the pinned comment. Let's continue. This research update presents Ark's new open source Tesla model, which incorporates distributions for 41 independent inputs to simulate a range of potential outcomes for the company. This, by the way, I personally believe is the way, not a way, the way to model out the potential for any company, including Tesla. How else would you do it? If you're not considering a range of different scenarios with a bunch of different inputs and then trying to weight the probabilities, and obviously it's a little bit of art and a little bit of science, you're doing it wrong. That's my obnoxious opinion. I think probability weighted scenarios is the most logical and reasonable way to model out a company in the future. What are the things that may happen? What are the ranges, the variations, the variabilities within each of those potential scenarios? For example, you might look at gross automotive margins. What's the highest margin Tesla might reasonably expect on a vehicle? What's the lowest margin? You've just got your bull and your bear case. Now, what do we think's likely? There's your base case. If people aren't going through this exercise, I don't know what they're doing. I don't know what they're thinking, if they're even thinking at all. Tesla's prospective robotaxi business line is a key driver, contributing 58% of our expected enterprise value and 45% of expected EBITDA in 2027. If you can't read between the lines, no robotaxi equals cut the targets in half and then some. Across our simulation set, electric vehicles account for 62% of revenues in 2027 at substantially lower margins than robotaxi revenue. The chart below breaks down attributable revenue, EBITDA, and value by business line. So let's have a quick look at this one. Electric vehicles in green, robotaxi purple, stationary storage, black human-driven ride-hail, and the light grey insurance. We've got revenue on the left, EBITDA in the centre, and enterprise value, as in market cap, on the right. Just in the interest of clarity, this $6.1 trillion enterprise value is where the $2,000 price target comes from. This article outlines 5 topics, including the risks and limits associated with our assumptions. It includes example bear and bull case outcomes, key model inputs and updates to Ark's 2022 Tesla model, the 2027 share price forecast, 2027 model considerations that are not key drivers of their price estimates, risks and limits, plus business opportunities not included in the model. And by the way, again, just a quick note for those of you with access to my valuation model over on Patreon. You've probably already have seen this, but for quite a while, I've had a bunch of exclusions explicitly noted as in these are not part of the valuation model, which include HVAC, which, spoiler alert, Tesla's now announced is going to happen, so I guess I'm going to have to add that eventually. Supplying batteries to other companies, supplying motors to other companies, which are possibilities, infotainment revenue, and importantly, Dojo as a service, which on Tesla's most recent earnings call just a couple of days ago, Elon said has the potential, not the certainty, but the potential to itself generate literally hundreds of billions of dollars of revenue per year. So the things that aren't being considered are important to note, because if they pan out, I mean, we're talking about some serious stuff. So it's always important, if you are modeling out a company like this, to consider the stuff that may occur that you're not putting in your model and note it explicitly. So let's look at some example bear and bull case outcomes. We do not provide a single bull or bear case because we dimension the bull and bear outcomes as the 75th and 25th percentile output from the simulation. I know we're getting a little bit nerdy, guys. I'll try my best to translate for the folks who start glazing over when they hear things like 25th percentile. Nonetheless, the table below represents what we believe are plausible examples for each case. So let's look at this. Example output, cars sold in millions. Ark's example bear case for 2027, 10.3 million vehicles delivered. Example bull case, 20.7 million vehicles delivered. And once again, I just want to make sure that the dweebs watching this understand, Ark are not making predictions, nor do I in my own valuation model. These aren't predictions. They're possible scenarios, possible outcomes. For what it's worth, my 3% probability bear case for 2027 has Tesla currently delivering just over 6 million vehicles. My bull case for 2027, which I have a 25% probability, I've got Tesla at 10.4 million deliveries. Interesting. My bull case is Ark's bear case. The caveat there, of course, I do have a hyper bull case, the one with the 3% probability I referenced earlier, in which Tesla does almost 11 million vehicles in 2027. Ark's average selling price in the bear case, $34,000. In the bull case, $26,000. Now, some people might be going, wait, what? Hang on. How can the bear case price be higher than... I don't get it. What's happening here is Ark's thinking, how much can Tesla drive their costs down? The more Tesla can drive their costs down, the more bullish, right? Kind of makes sense. The cheaper they can produce vehicles, the more vehicles they can sell. Again, for context, my base case ASP in 2027 is around the same point as Ark's bear case. So we've got electric vehicle revenue as well. In the bear case, about $1/3 trillion, and in the bull case, over $500 billion. Let's continue. We've got ride hail, net income in billions, 200 in the bear case, 613 billion in the bull case. EV gross margin, bear case 34%, bull case 23%. But now some key model inputs. Using Wright's law, electric vehicle gross margins never exceed, in the worst case, 20%. In the downside, they never exceed 40%. In the upside, they never exceed 60%. And the best case could be as high as 80%. I know people are losing their fucking minds right now, by the way. As I personally have said many times, I expect Tesla will be able to produce an extremely compelling electric vehicle for about $12,500 in today's dollars sometime later this decade toward the end. I don't believe they're going to need to sell that thing with a 30% margin. I expect it'll be significantly higher. A margin somewhere in the 40 to 60% range is absolutely within the realms of possibility. Again, if you guys want to look at all the different inputs and variables here, you're absolutely welcome. Ark Invest also have robotaxi launch periods, interestingly. They've got 2026 in the downside scenario, Q4 2023 in the upside scenario. Personally, I have the first robotaxi fairs taking place somewhere on Earth toward the end of 2024. Ark noting some of the updates they've made to their model, including assumptions and inputs for autonomous ride hail, capital efficiency estimates, stationary energy storage deployment, and of course, they've extended their share price forecast by a year. Assumptions and inputs for autonomous ride hail. Ark has grown increasingly confident that Tesla will launch a robotaxi service soon. Our updated Monte Carlo model includes a range of launch dates with late 2024. Oh, what? Damn, dude. But that's pretty funny. I just was finished saying that I've got late 2024, and it turns out that Ark's weighted average launch date for robotaxis is also late 2024. How interesting. Have they been copying my homework? I'm just kidding. So, we're looking at the percent of simulations indicating first year of Tesla robotaxi commercialization. Again, to translate for the people who aren't ultra nerds here, the bigger the bar, the more likely that's the year that robotaxis launch. So really, we're looking somewhere on that 2024 to 2025 mark, hence Ark's weighted average is late 2024. Interestingly, by the way, basically 0% probability that the robotaxi network launches any time after 2027. The recent flurry of AI progress, from large language models like ChatGPT to image generation diffusion models like Midjourney, should accelerate innovation in the autonomous driving industry. Tesla, for example, already uses transformers popularized by large language models for lane and intersection prediction. I mentioned this previously, but it's kind of important because a lot of people are unaware that a lot of AI progress happening now in language, in image generation, is actually going to translate and be very applicable for Tesla's full self-driving. In our view, Tesla's vertical integration strategy and Dojo training supercomputer are key competitive advantages. Training currently runs at 100% capacity, suggesting that Tesla's plan to expand Dojo by 2 orders of magnitude next year will help the company shorten the time between model updates. Recent videos of its latest FSD software update, including one of a driver who nearly completes a full ride hail without touching the wheel, suggest Tesla is close to launch in some geographies. Tesla's data library should help prove statistically the safety of its vehicles, giving it a significant advantage over peers in the regulatory approval process. Tesla's custom-owned fleet drives more than 120 million miles per day and over 1 million miles per day in FSD. In contrast, make sure you're sitting down for this, in their multi-year lifetimes, Cruise and Waymo have reached just 1 million miles each driven on public roads with no one behind the wheel. Please take a moment and let that sink in. Per day, just Tesla FSD users, which aren't even 1% of the total miles driven in Tesla vehicles, per day over 1 million miles. Whereas Cruise and Waymo, in their entire lifetimes, years, have just cracked 1 million miles each. Of course, the competition is coming, especially with the autonomous vehicles, because I saw it on a leaderboard somewhere on the internet saying that Tesla was last, therefore they must be last. Moreover, accident statistics suggest that Tesla already has achieved performance superior to human drivers. Now, don't get triggered here, they're not saying in every single situation, this is just statistically speaking, based on data about accidents. Doesn't mean that Tesla's software is perfect in every scenario, but on average, you're less likely to be involved in an accident when you're not the one driving your Tesla. According to our research, adjusting for its use on surface streets only, Tesla's FSD is 5 times safer than a manually driven Tesla. And we can see here, adjusted million miles per crash on surface streets only. Sometimes the chart says it all, so just look on screen. Don't even need to look at the numbers. It's kind of pretty obvious, right? Tesla FSD, bigger bar, the longer you drive before you have an accident, it's pretty clear. Capital efficiency estimates. Tesla's capital efficiency in 2027 remains the same as last year's forecast for 2026. Capital expenditure per incremental unit of capacity improved from $84,000 when the Model 3 was ramping in 2017 to $7,700 in 2021. Simultaneous production ramps at 2 gigafactories led capital efficiency measured at the end of the year to increase to $14,755 in 2022. Once the initial ramp of those factories is complete, the implied capital expenditure per unit capacity continues its decline to $7,000 as shown below. And again, Tesla's capital efficiency per incremental unit of capacity. Black, we've got historical data. Yellow, the spec down here. Actual data, but keeping in mind factories are ramping, so this is kind of being pushed up artificially. As those factories ramp, it'll come back down. And then in green, we've got the Ark downside forecast. In other words, Tesla can barely drive their cost per unit of capacity down any further at all. And in the upside forecast, it continues to decline precipitously to around $2,000 by 2027. And again, some people are going to get triggered. Well, that's not possible, bro. How could they do that? You may have forgotten that Tesla's new manufacturing system, half-price vehicle, less robots, more efficient, get more done with less. Tesla keeps deleting parts and processes. It seems fairly likely that Tesla's cost per unit of capacity will continue to decline over time as they innovate, delete parts and processes. While these improvements indicate that Tesla could continue to increase margins, the more important takeaway is that capital is not a bottleneck limiting growth. Instead, Tesla should be able to grow as quickly as management bandwidth and supply constraints allow. 2 factors we model by constraining Tesla's annual production growth using the max annual production increase input. Tesla's Investor Day on March 1st, 2023 highlighted its next generation vehicle architecture and manufacturing process. Man, I should have read this ahead of time. I literally just said what Ark's saying now. Including steps to reduce the footprint and time associated with building factories, which should reduce bandwidth requirements and accelerate scaling. Stationary energy storage deployment. We expect Tesla to prioritize its vehicle business. To reflect this in this year's model, we scale its stationary energy storage business only as the vehicle business becomes scaling constrained. According to our analysis, energy storage should contribute $6.6 billion or 3% to Tesla's expected enterprise value in 2027. In Ark's expected value, around 16% of all battery capacity goes into stationary energy storage and around 84% goes toward vehicles, resulting in around 200 gigawatt hours of stationary energy storage deployed in 2027, as shown in the second chart below. What we're looking at here, megawatt hour allocation, purple, energy storage, black, automotive. Pretty simple, right? And now the second chart, annual stationary energy storage deployment in megawatt hours, expected value as in enterprise value case. So we can see here, makes barely any difference whatsoever in 23 or 24 or 25, and to be honest, even in 2027, it looks like a lot of growth, and it is. Ark's still expecting that this will only be 3% of Tesla's total enterprise value. Ark's research suggests Tesla will use batteries for the most profitable use case. A robotaxi should provide the highest investment return on batteries for Tesla, as shown below. I mean, this is kind of obvious, high utilization, kind of goes without saying, but we'll talk more about it anyway. With a robotaxi platform, Tesla should be able to generate earnings from both the vehicle sale and a recurring ride-hail revenue stream, which Ark believes could generate software-like margins. As Elon Musk has phrased it, autonomous ride-hail, quote, probably will be the biggest asset value increase in history. And here's the 2027 average EBIT per kilowatt hour deployed expected value. In other words, how much of a return is Tesla getting versus the amount of battery cells they're needing to put in a product. As we can see here, electric robotaxis, obviously, far and away the biggest ROI. This is a dedicated robotaxi. Next is electric vehicles with ride-hail, straight up electric vehicles, and then we've got stationary energy storage installation. By the way, keeping in mind that Tesla's mission is to accelerate the world's transition to sustainable energy, obviously, they get the best ROI in terms of their mission, irrespective of the dollars and the kilowatt hours, just in terms of their mission, by deploying robotaxis widely. According to our analysis, the stationary energy business should yield margins of 20 to 25%. We have not modeled the option value embedded in Tesla's ability to turn its battery systems into virtual power plants that allocate dynamically to overtaxed electric grids, or returns from participating in capacity markets. And for the record, these could be potentially gigantic revenue and profit streams, but Ark's just explicitly pointing out it's not even in their model. File under exclusions. Tesla also could accelerate its energy storage strategy by vertically integrating cryptocurrency mining and home HVAC systems. For now, consider such options beyond the scope of this model. So again, HVAC and potential crypto mining, also not included in the model. And now the share price forecast. Our simulation is highly sensitive to the year in which Tesla launches robotaxis, makes two of us Ark, as shown in the two charts below, which we'll look at in just a moment. The chart titled Modeled Share Price Outcomes represents the likely distribution of all possible price targets from our Monte Carlo analysis and identifies bear and bull cases as the 25th and 75th percentile outcomes respectively. Expected value is the average of all 1 million simulations. The chart titled Modeled Scenarios illustrates the mix of robotaxi and human ride-hail outcomes that corresponds with each share price represented in the prior Modeled Share Price Outcomes chart. In our lowest price per share scenarios, Tesla launches a vertically integrated, human-driven ride-hail service, but does not launch a robotaxi network, as shown in dark grey on the lower left-hand corner. Although Tesla is not committed publicly to launching human-driven ride-hail, Ark previously detailed the strategic and tactical advantages of doing so. Note that in many of our higher price per share scenarios, Tesla launches a robotaxi network within the next 2 years. So, let's look at this chart. Modeled share price outcome. Scenario mix within bins of 1% probability. Again, just to translate the jargon, these are all the scenarios that have at least a 1% probability. They're not including the stuff with a 0.042069% probability. Anything that's 1% or above. Now, just in the interest of comparison, I'm actually going to stress test this versus my own model right now. As I mentioned earlier, Ark's bear case is 25% probability, as is their bull. My bull case is 25% probability, but my bear case is 3%, and my hyperbull case is 3%, which means I'll be capturing the sort of extreme ends of this as well. Looks like Ark's absolute worst case bear case scenario here, let's call that about, say, $750 per share. I'm a little bit below that mark, but not too far off it. And in the most extreme upside scenario, a little under 6,000, I'm considerably above that. And again, just so you guys understand, if you're not a total nerd, the expected value of $2,000 is smack bang in the middle of the 25% and the 75% probabilities. Now we're looking at the different modeled scenarios. Stacked top to bottom, the short story here is that the sooner Tesla launches robotaxis, the higher the valuation in 2027. Should go without saying, right? More robotaxis on road generating income, the more Tesla's worth. 2027 model considerations that are not key drivers of our price estimates. As the updated model extends the forecast 1 year to 2027, we note the following considerations. Debt financing. The midpoint of our assumptions suggests that Tesla will fund 25% of the build-out of future factories with debt. Bitcoin assumptions. We updated our Bitcoin assumptions in line with Ark's current Bitcoin expectations. The digital asset continues to have less than a 5% impact on our 2027 expected price per share. By the way, that's actually still really fucking massive. Equity raise. As in last year's model, we assume Tesla will use around $3 billion in additional equity for incentive compensation. Given the cash we expect from the autonomous ride-hail network and electric vehicle sales, we do not anticipate that Tesla will need to raise more capital. Yeah, I'm just going to put this on the record. Unless I get absolutely blindsided and Tesla decides to build out the biggest fucking robotaxi fleet of all time, plus the biggest humanoid robot fleet of all time, and does so on their own dime and doesn't sell them to customers, I don't think they'll ever need to raise capital again, ever. Yes, I said ever, and this is on the record, and I may be embarrassed in the future, but I'm just saying. It's extremely unlikely to me, except in just how did I see that coming scenarios, that Tesla will need capital again. They're a money printing machine. They've already got over $20 billion in cash and cash equivalents, and they're stacking billions of dollars per quarter. The biggest problem Tesla will face in the future is finding ways to spend their gigantic mountain of cash. Balance sheet. We have made conservative assumptions about strategic financial decisions. We do not believe these decisions will be primary drivers of Tesla's stock price appreciation. Tesla holds cash and shitcoin on its balance sheet and does not benefit from any yield-generating assets. With more cash than debt on its balance sheet, Tesla does not use the cash to pay down debt. The interest costs of the debt remains at 4%. Tesla does not repurchase shares. May not age well. And a bit of a caveat here, let's skip over. If you want to read it, pause the video. Business opportunities not included in the model. We do not believe that either Dojo Training as a Service or Tesla's Optimus humanoid robot will contribute significantly to Tesla's value within our 5-year investment time horizon, although they could drive value over a longer time horizon. Same boat here. I'm not even modeling out Dojo as a training in terms of the Optimus bot. I do model that out, but it makes almost no impact. In fact, to be honest, it barely makes an impact this decade, but holy shit, if you guys could only see what it looks like in the 2030s and 40s. Risks and limits of our Monte Carlo model. Ark's 41 independent variables are meant to cover all scenarios that we see as plausible outcomes for Tesla over the next 5 years. And again, this is the same type of thing that I do in my own model. I'm not making predictions, I'm just thinking, what are all the plausible scenarios? What's the worst case? What's the best case? What's the absurd best case? What's the absurd worst case? What's likely? That's what I'm trying to consider here. And like I said, I really think that if you aren't probabilistically modeling out Tesla like this and thinking about different scenarios and probabilities, you're doing it wrong. An unexpected event, such as Elon Musk's sudden departure from the company, or a natural disaster, or scamdemic, could cause actual results to differ from our expectations. Conclusion. Given the updates outlined in this article, Ark's price target for Tesla is $2,000 per share in 2027. Our bear and bull cases suggest that Tesla could be valued between $1,400 and $2,500 per share in 2027. We have published our simulation model on GitHub and invite readers to explore and test assumptions and or craft visualizations in the simulations. And by the way, I will be looking through Ark's full model in a future video. So there you have it. Ark Invest expecting, give or take, Tesla to be worth about $2,000 per share, aka a more than $6 trillion market cap in 2027. Could be a little bit less in the bear case or considerably more in the bull case. And this with many significant exclusions, including Dojo as a Service, Tesla HVAC, and plenty more. I think even in the worst case scenario, most Tesla investors would be happy with $1,400 per share just a few years from now. I certainly would. But just quietly, I kind of hope it's a lot less than that because I'm probably still going to be buying then as well. And the cheaper, the better. I'll tell you what, guys, it has been a very big week. Started producing Twitter content exclusively, still producing Patreon content. There was Tesla earnings, 2 Starship launch attempts, 1 success, followed by a RUD, Ark's valuation model. Also now launching my Twitter subscription-only content. I've been a very busy boy, and thank fuck, Athletic Greens AG1's here to help. You guys will know now, I've been taking this for more than 2 years. It's massively improved my energy. I feel and perform way better. I do everything I can to optimize my overall well-being, but I tell you what, in terms of bang for buck, nothing comes close to Athletic Greens AG1. Great way to fill in nutritional gaps. 1 scoop once a day, every day. It's that simple. It's full of 75 high-quality vitamins, minerals, and whole food source nutrients, plus prebiotics and probiotics and digestive enzymes and adaptogens to help you deal with stress. Plus, if you head to athleticgreens.com/SMR or use the link at the pinned comment, get yourself a 1-year free supply of vitamin D3 and K2 plus 5 travel packs. But you don't have to take my word for it, after all. With extremely legitimate testimonials like these that I didn't make up, which you'll be able to tell when we begin, it's pretty hard to argue. Let's read the first one. My Monte Carlo simulation suggests a base case of you'll feel and perform better on AG1. My bear case suggests you'll poop more regularly. My bull case suggests you'll feel amazing and have more energy than you know what to do with. From Tasha Athletic Greenie, customer since 420. It's a weird name. How about this one? In 2027, we expect you'll still be taking AG1 because you feel and perform better. In the bear case, you are overcome by trust issues. Never try AG1. Weird since there's a money back guarantee. And don't feel or perform better. And in the bull case, you love AG1 so much you buy it for your family and tell all your friends about it. From the Gilf of Wall Street, customer since 1970. What's with these weird names? I feel like these people are trolling us. And one more. Before I started taking Athletic Greens AG1, I didn't understand exponential growth, cost curves, Moore's law, or how important data is to solving autonomy. Plus, I was married to a beta simp I hadn't wanted to bang in years. That's a bit inappropriate. At least she's honest. I was also long GM and Ford and thought Tesla was going bankrupt. Within a few weeks of starting AG1, my brain seemed to turn on for the first time in years. I dumped my husband and legacy automotive stocks, bought some Tesla, and have a new feeling of hope for the future. Thanks AG1. From Monkey Branch. Strange fucking names today. So, if these super legitimate testimonials haven't convinced you, I don't know what will. But seriously guys, I implore you, try Athletic Greens AG1. Just head to the link in the pinned comment or athleticgreens.com/SMR. Just try it. If you don't get the effects you're looking for, great, get your money back. That's literally what the money back guarantee is for. What do you got to lose? It's finally time. Head to athleticgreens.com/SMR or click the link in the pinned comment. Start your daily health habit now and please let me know how you're feeling in a few weeks' time. And remember, I'm now posting early access to my daily YouTube videos, including this one, to my Twitter subscribers, plus a load of additional content, including a new Q&A that just dropped. Also posted major updates to my Tesla Valuation model over on Patreon, which you can join with the card in the corner or the link in the pinned comment. And in addition to that, posted another update on a recent biohacking experiment, also available exclusively over on Patreon. Like I said, I'm going to be a busy fucking boy. So see you guys over on Twitter at Stephen Mark Ryan and or on Patreon. Love ya.